This with Royce Mendes, who's managing director and head of macro strategy at Desjardins. Nice to see you, sir.
Nice to see you as well.
So, I don't know, it feels like a bit of a tug of war out there, the Bulls versus the Bears. How much of the economy and where we go from here is at the center of it, in your opinion?
I think the key word is resilient. We've seen it in a lot of the economic activity data. You mentioned the GDP revisions today. It all points to the fact that interest rates are not working as they were intended to do or as they were expected to do. We came into this year with a lot of people bearish on the economy because interest rates had been raised at a historically fast pace. And they just haven't done what a lot of people expect them to do. They haven't slowed economic activity as much as some economists expected, and they haven't pulled inflation down. If you look at underlying inflationary trends, they're still too high to be consistent with the Federal Reserve or the Bank of Canada's 2% target.
And so against that backdrop, like let's forget about everything else and let's look at inflation data and the tools that central banks have. What are your expectations? I referenced, the market. I'm even just looking at the swaps market this morning. It seems like that expectation will see another couple of rate hikes is what the expectation is right now.
I think that's probably right. But surprisingly, when we got the Canadian CPI data, there were a lot of economists cheering the fact that headline inflation had fallen to pretty low levels. The problem is that the real story is on core inflation, and it's the core inflation metrics that the Bank of Canada is tracking.
While you're talking, can I just maybe throw we like our charts, and I know you like your charts too. We may have a chart which just shows some of the services inflation in the economy as well. That's, to your point, easing inflationary pressure depends on what prices we're talking about.
Yeah, that's exactly it. What we want to do is we want to strip out all these volatile components. And of course, we want to strip out those mortgage interest costs that people are all talking about.
Sure.
The fact that the Bank of Canada raises rates and that actually feeds into higher inflation. We want to exclude that from the calculation. So we look at things like the Bank of Canada's core, median, and trim. But specifically, we really like the Bank of Canada's core services excluding shelter metric. And that is still very elevated. All of the core metrics, though, you'll see there are just moving in a sideways trend. That's a problem. The Bank of Canada wants to see progress towards the 2% inflation target. And when you look at these core numbers, they don't show progress.
Is there a possibility, though, like services is a pretty general area, but if I think people, are traveling and have been willing to get back out and go to Taylor Swift concerts or whatever they're doing right now, but if the economy does start to cool down, that they might spend less on those things, and that might ultimately bring down services.
I actually think it was Beyonce who was blamed for the inflation.
Yes, that's right. That's right. That was true, actually.
It's true that there is some pent-up demand. It's true that there is excess savings in the bank accounts of Canadians. But if you look at some of the employment numbers, if you look at the economic activity numbers, even after accounting for population growth, they're still very strong. And we can't just hope that eventually, the economy will cool down because some of those temporary factors have begun to wane. We have to take action because the longer we live with higher inflation, the more likely it is to get entrenched in the decision-making processes of businesses and households.
So you think the Bank of Canada does what from here? How many more rate moves could they potentially have going forward?
I think July is very likely that they raise rates. I think globally what we're seeing is central bankers talk about further rate hikes. And I think there is a risk that the Bank of Canada needs to do more after that. But I think you are seeing globally a coordinated effort amongst large central banks to try to get control of this second phase of inflation. The first phase was the easy part. The first phase was getting inflation down from 8 or 9% in North America down to these 3 or 4% levels. The next phase will be getting it back to 2%. And that was always the part that people worried about having problems, where things might get sort of stuck at a higher level. And that's what we're seeing in the underlying inflationary data, is that things have gotten stuck.
I do want to tie it back to the broader markets and their assessment of all this stuff. Before I do that, there's so much focus on central banks, but governments around the world have done plenty of spending, certainly going into the pandemic and even coming out of it. We actually had an interview with the NDP leader, Jagmeet Singh, yesterday. It was in New York. I guess meeting with different people about strategies on dealing with inflation, and he has looked to taxes on excess profits in the corporate world as a way to address inflation right now. But I asked him about the fact that the IMF itself has said maybe Canada should have a fiscal anchor on our spending. How challenging is it to say, oh, these central bankers have to tackle inflation when governments are still spending oodles of money?
You know, in theory, it would be great if you could tax excess rent. In practice, I don't know how you do that. So I'm not sure that that's very practical. I think when you look at what governments around the world, and you know, in North America, we can talk about the governments here, they're not rowing the same way as monetary policymakers, and that's not helping. While I think, you know, the fiscal impulse is not necessarily hurting because we're spending less than we were in years past, it's not necessarily helping, and it's not a great sign that when we're at sort of full employment, we're at the top of the economic cycle, that we're not really running, you know, closer to balance in terms of budgets.
So before I let you go, let's tie it back to the market. So there's obviously more work, it seems, in your view, to be done by central banks to fight the inflation story. I wonder if the willingness of investors to at least keep tabs on what's happening in the equity market, it ties back to the fact that if the economy is resilient for now, if it hasn't turned over, then why would I jump out of that boat for now?
Absolutely. It makes complete sense. The economies have proven far more resilient. The worst case scenarios that people were worried about at the beginning of the year did not come to fruition. And the economy and by extension profits are proving to be pretty strong. The problem is that we have to think about what the end goal of the central banks is. And it's to get the economy back into some equilibrium, which is just code for slowing it down. And unfortunately, it's hard for them to calibrate that slowdown. So while they're aiming for a soft landing, it'll be very difficult to achieve that.
Okay. Well,